Good day, fellow investors. Yes, what stock to buy is the key question on YouTube, but perhaps it is more important to know how to manage your portfolio and how to trade around those positions you have. For example, it is very important to know when to buy something, when to sell something, and whether you should buy more when the price is down. And portfolio management and trading might be not a value investment, long term investment title, but we will share key insights that will help you understand how to improve your long term investing returns through portfolio management and trading too. You'll have a surprise there. The key topics we'll discuss are liquidity, how much cash, diversification, trading, and the surprise there comes that even Warren Buffett is a trader because he usually sells 9 out of the 10 positions that he has. That's a video we did 2 months ago. You can check it in the link in the description below. Then following the market is necessary so that you stay in touch with the market, and then consequently you know how and when to buy a stock, what's the process there, when to sell, even more important, perhaps even harder. And I hope that these points will answer the key portfolio management questions you might have when it comes to your investing. Because keep in mind, investing is a process, and that process has to be understood. And we'll do that today. And any questions, comments, because these are delicate subjects, please let me know in the comment section down below, and I'll do my best to answer those questions. In return, all I ask is just a like to support the channel. Thanks for that, and let's start. Step 1. Let's start with liquidity, and then we'll go on to how diversified you should be. When it comes to liquidity, of course, there is cash, then you use that cash to do your investing with the hope that you get more cash after the investing performs well. This will later be touched also on with the buying and selling, when to sell, when to buy. That is an essential part of liquidity. But the key points of liquidity are cash flows that reduce opportunity costs, because if you have cash, you can take advantage by those opportunities that are often offered by the market. If you don't have cash, then you cannot take advantage of that. So there are two ways of doing that. Yes, investing is about the long term, but you have to manage that risk. And then dividends, of course, allow you for reinvestment, and periodic cash that you get when you sell something also allows for the improvement of the risk and reward in your portfolio. For example, periodic liquidation keeps you also sharp, because if you sold your Twitter to Elon, you got the cash, and now you have to see, okay, how can I invest that money to avoid deadwood in your portfolio? And the key is that you always improve your portfolio so that you water your flowers, that keeps on growing. And a big mistake that most investors make, they water the weeds where those weeds just keep going down. If we can make that hard distinction, then we have nothing to worry about our long-term investment performance. But by constantly checking what is better, when it is better to hold cash than a position, depending on the risk and reward, managing that liquidity depending on the opportunities, that is already a step forward to great investing. Because when you get your cash, then you can reinvest it. And the point of avoiding deadwood is perhaps Warren Buffett's Coca-Cola example. He had 10% of the company, so it was hard for him to sell, but Coca-Cola, with a relatively low dividend for Warren Buffett, didn't do much over 20 years. Apple, that he bought in 2016, did a 5x, while Coca-Cola is just up 1.5 or 50% up. So that's not much. And we as retail investors can be more nimble and can, let's say, trade out of the exuberant positions, get into cash, and then do better with that. Just a note on liquidity, Klarman also mentions liquid versus illiquid investments. And of course, if something is illiquid, you require higher compensation for that. Depending on the years you have to wait to generate cash back from that investment. Examples of that are angel investing, venture capital investing, versus buying Berkshire that you can sell after a minute of buying. Now, the next step when it comes to your portfolio is diversification. With Klarman, diversification is very simple, and he says that 10 to 15 positions is enough because you don't need to diversify just for the sake of diversification. The key is not how many positions you have in your portfolio, but how different are those and what are the risks of those positions in your portfolio, because you never know what can happen in the future. So yes, we have to be diversified, but then also the number of diversification. Warren Buffett owned 60% of his assets in American Express when he knew it was a great investment. So how diversified you are will also depend on how certain you are that something will or won't happen. How much risk is there in a great investment or position? So when it comes to diversification, this is a huge topic, and I'll note it down to make a specific video where we'll elaborate everything there is to know about diversification so that you know what kind of diversification at what moment in time is best for you. Subscribe for that. Thank you. Now, second step here, the importance of trading, which doesn't resonate to the long-term investing mantra that is usually attached to value investing, but it is an essential part. And let's immediately check what Seth Klarman did over time. This is his stock market portfolio allocation over time, and you can see how he really is all over the place, taking advantage of the opportunities there. And just to go deeper into an example, this is Cheniere Energy, and he was buying the company here and then he sold here. So he was seeing low risk in the energy natural gas system then, and perhaps this explains it better. So you can see when the prices were relatively high in 2014, he didn't have much of energy, Cheniere in this case. But as the prices went lower, this will also be discussed later in the buying, he bought more and he increased his position too. This is 30-40% of his stock market portfolio in 2016. And then as energy developed and his thesis materialized, he started lowering to almost zero, where energy prices were high enough for him to liquidate, and he is now into something else, more into communication. So he's always managing that risk and reward and trading. Let's look now at what Klarman is saying. This is what he has been doing, and it is in line with what he is saying. The key to understand is that we as value investors are first and foremost driven by price. Risk is a function of price. Our investing is a function of price. Everything is a function of the price you pay, and we have to take advantage of the market irrationalities that are often an opportunity for us. For example, as a value investor, you want to buy below intrinsic value, and then, yes, when it is overpriced, you want to sell and take advantage of these market opportunities, and then also when the market is panicking, buy again and then sell again. Why do you buy and sell? Because you don't want to lose money, you don't want to take risk, which is the key of value investing. You want to manage risk first, and that is the key here, because that's the only way, by managing the irrationality of the market, that's the only way to achieve good long-term returns for low risk. So as we discussed, Warren Buffett sells 9 out of 10 positions, which is insane, but it is true. Seth Klarman also buys low, and when something materializes, he trades it for cash, for liquidity, for other opportunities. And that's something we'll discuss a little bit more in the next steps, which is when to buy and when to sell. But before when buying and selling, the key is that we stay in touch with the markets. And of course, as investing is the function of price, you want to watch those prices, but not too much. Because if you watch those prices too much, then you start reacting to price changes with your fear when things go bad and greed when things go good, which leads to more trading than necessary, and you go into the Wall Street broker game where their incentive are to take advantage of your money. The more you trade, the more your broker makes money. And this is just from one broker that I have. They send letters. If you want, they will send letters every 2 seconds, emails about this and that happening. In this case, the dollar declines on US midterms, and they want you to trade on that. They want to play on that panic and fear, which is absolutely not what you want to be played on. As Mao Zedong said, if somebody is going to screw you, at least pick the position. Now, let's go to the most important part: how to buy, when to sell. When it comes to buying, the first difference we have to make is whether you are a speculator or an investor. That's the key component to understand. Because if you're an investor, you are affected first and foremost by price, which means that if the price goes down, what do? You are happy because you can buy more. However, most investors are affected by fear and greed. If the price goes down, they are affected by fear. If the price goes up, they are affected by greed. And when it comes to investing, this is the S&P 500, and at some point in time, it was down 25% this year here. But here, most that I could read in the comments here on YouTube and everywhere was fear. Fear about what's going to happen, about what will the Fed do, where will the market go, and everyone said, oh, now it's the time to wait. Consequently, just a month later that things look much better, oh, now stocks are a buy. However, value investors just look at the price, and then higher price, of course, it's a worse buy than lower prices. Thus, the key component of buying and understanding when it comes to investing is you have to be ready to average down. And when you solve this problem for you, then you are an investor. For example, let's say you buy Google here or you buy Google here at 100 now, and if it goes to 50, what do? If you are simply happy, okay, if Google goes to 50, I simply buy more, then you are a real investor. If you buy Google now because it's a good business at a fair price, and then it goes lower and you panic, then you are just a speculator. So this is the key way of answering the key question whether you are an investor or a speculator. And this also touches on how much cash that we discussed in the beginning. If we want to average down, we need to have more cash. However, this is Seth Klarman. He's a business owner, fund manager, hedge fund manager, so he has to manage that. But most of us retail investors have monthly income that allow for more cash and consequent buys if necessary, dividends, etc., etc. But you need to understand investing and have the guts to buy more when prices are lower. And to answer also the question when to buy something, when to start buying, the answer is pretty simple. If you know the intrinsic value, if the price is lower, then you buy. How big the discount depends on other opportunities you have, but at some point in time you have to see, okay, if I buy this now, what is the return from the investment, the dividend, the earnings, the growth, and if you're happy at that price with that investment. That's about it. Of course, market fluctuations, we can't predict those, so we have to be ready to average down. Now, when to sell, which is the hardest decision of all, to sell something, because when it comes to the market, you never know. Even if it is overpriced, it can always go up another 2x. So if you made 2x times 2x, it's already 4x. If you made 4x here, it can also go to 8x. So when it comes to this and then greed starts playing in, you're forgetting about the risk because you have already made a lot of money, but value investors know that, and you sell something and then it goes higher, and that is investing. When it comes to selling, according to Klarman, it is a comparative exercise. You always want to focus on the risk first, and then when the risk goes up or something, you compare it to other opportunities, and then you exchange that for others less risky opportunities, because you don't want to lose money here and see those risks materialize. Therefore, you must be very cognizant of your emotions when it comes to investing. And then Klarman discusses the inversion method, usually that Charlie Munger says. So if you're not going to sell something when the risk has increased and the return has diminished, what are you going to do? What else is there than a value investment philosophy? If you haven't bought based upon underlying value, how do you decide when to sell? That means you're just speculating. And when do you take a profit or cut your losses? Do you have any guide other than how they are acting, which is really no guide at all? So, rhetorical question, but then again, the answer is of course, you don't have a guide except for watching how the stock is acting, and therefore, value investors simply focus on risk, and over time, you will do well. You might miss a lot of upside, but then again, you might miss a lot of downside. And to summarize, value investing is about doing the research and finding those opportunities and waiting patiently, being disciplined to buy those underpriced opportunities. When those are overpriced, you translate them into cash, and then when there are other opportunities, you again buy that. And everything is based on the fundamental principle of value investing, which is managing risk. And if you want to learn more, check if you have missed some of our margin of safety summaries. Chapter 14 is the next one with investment alternatives, and then we'll conclude with 10 key concepts that I have gained from rereading and doing this summary of the margin of safety. Thanks for watching, and I'll see you in the next video.